Hey there, YouTube. I'm going to show you why beef prices have gone through the roof. I'm going to go into a little bit of supply side dynamics and a thing called the New World screwworm, which is having an impact on cattle south of the border and its impact on the U.S. At the end of the video, I'm going to show you how to conduct a trade to take advantage of potential opportunity using beef commodity and hog commodities. So with that, let's jump in. All right, first thing we'll look at is supply side dynamics. We are at a multi-year low. In fact, we're at a 73-year low in cattle inventory. So when you look around the U.S. and you're driving by feedlots, you'll probably notice fewer cows today than you did in times past, or maybe when you were a kid. So looking back to 2000, you can see we were running around 97, 98 million head of cattle in the U.S., and now we're only down to 87 million. Zooming out, going further back, take a look. This is going back 50 plus years. That cattle price or cattle inventory has been dropping year over year. This is an interesting trend. I was talking to a buddy the other day, and he said, "You remember when we were kids? There used to be feedlots, and there used to be cattle markets, auctions just right around the corner. There were 3 of them within a 10-mile radius of his house." And he said now he has to drive 40 miles to go to an auction. So it is interesting. I remember the same thing, and you just don't see quite as many auction houses as you used to. There is a interesting trend over the last 50 or so years that this cattle inventory has been dropping. And it takes a long time to increase cattle supply. You think about, you got to keep heifers back, and it takes a year or two for them to be ready to start producing and breeding. Well, then it takes another 9 months for those calves to start having babies. And so it takes a long time to really build up the inventory. So I do believe inventory will probably build up over time, but it's going to take a while, a long while. So right now we're doing a lot of imports to augment this. So when you look at the demand side and you're like, okay, our inventory is dropping, but look at our demand, it's going up. So this is in billions of pounds. From 2004, we were roughly 24.5 billion pounds of beef is what the U.S. consumed. We're up to about 27 billion pounds of beef. That's a lot. That doesn't just include us either. That's just U.S. consumption. If you look at our exports, look at Japan and South Korea, we actually import some good quality meats over there. And South Korea, their demand has increased. They're about 3 billion pounds a year. And Japan is also increasing. And then look at China. Look at their demand from the last 10 years. They've tripled their demand. They went from 500 million pounds of beef importing from the U.S. to 1.5 billion. So all of that's going to have impact on our prices, and that's why you've seen beef prices continue to rise over the last several years. But to help augment this, we do import beef from other countries. Australia is number one. We import almost 1 billion pounds of beef from Australia. A lot of grass-fed beef comes from Australia. And then you've got New Zealand, Canada, Mexico. I'm going to jump into that here in a second because there's something very big that's happening in Mexico that's causing an impact on our prices. Roughly 450, 500 million pounds of beef comes from Mexico. And then Brazil. Brazil is also increasing quite a bit. So when you look at our imports of beef in terms of percentage, we import about 5 billion pounds of beef from all these other countries. Australia being 24% of that. Canada is 22% of that. And then you've got Mexico and Brazil. 2 things happening right now that's having an immediate impact is one, tariffs. So Brazil, while they only represent about 300, 400, maybe 500 million pounds of beef, 15% of our imports, tariffs is having a pretty big impact. Trump just announced a couple of weeks ago that we're putting a 50% tariff on Brazil, which is going to have a direct impact on those beef prices. One of the number one things we import from Brazil. And then Mexico as well, tariffs against Mexico. But there's even a more important thing. When I was doing my research on this, and I thought, dang, are tariffs really going to cause that big of a problem? Is there something more to this? And so doing a little bit more research, this guy is the problem. It's the New World screwworm. It is a fly that, unlike regular flies where they lay maggots on dead carcass and dead meat, dead things, this guy lays maggots on live flesh. and it's extremely painful. It's got like these hooks and it goes in, it digs into an infection and sits there and eats away at a live animal. And it sits there for 7 to 10 days as it incubates and builds up. Meanwhile, they'll lay 500 maggots in one open sore and destroy it, cause a lot of pain. In some cases, can actually kill the animal within 7 to 10 days. What I'm going to show next is pretty gruesome. Hold on, I'm going to go ahead and show it, but I want to give you a quick warning. It's pretty gross because it is what these flies will do. This is a white-tailed deer. You can see it was killed. It had a sore on its neck, and this is what the New World screwworm did. It got in, ate it, and eventually killed the deer. This is a very impactful thing that these maggots are doing. This is a cow. Looks like something happened with its eye, and it continued to just eat away at it. It will kill an animal within 7 to 10 days if the infection gets bad enough. Now, this was eradicated back in the 1960s from the U.S., and the way they eradicated it is the U.S. created a sterile male fly to go out and mate with the female flies so that they couldn't produce maggots, and that's how they eradicated it from the U.S. That was back in the 1960s. And we created a border, if you will, with Mexico, so we helped Mexico eradicate it as well. So it has been largely contained to the south of the Panama Canal. The problem is, lately, we've been seeing a large increase above the Panama Canal, and it's starting to creep into Mexico. And this is what's been causing a lot of the prices to increase over the last several years. So you've got 50,000+ cases in Central America, and it is starting to creep up into Mexico. Let me jump into that. So if you look at Veracruz, this is the country of Veracruz right here. There was a case reported the other day, in fact, about 2 weeks ago, and this has caused our borders to stop letting cattle in. They had just started a reopening in Arizona, Douglas, Arizona. They had let 1,000 head through, and they were going to open up a place in New Mexico and allow more cattle to come through, and they were going to do this phased reopening. That all got shut down 2 days after the reopening, and because of this case down in Veracruz. Now, the Mexican president has told the USDA secretary that we're over-exaggerating it because there's just one case and it's been taken care of. But it's a huge threat to United States ag and United States livestock, United States animals. It's a very big deal. So I don't know that it's an over-exaggeration. It's definitely a precaution. Where we're at is that first case was detected in southern Mexico in November of 2024. They started the phase reopening, which I mentioned a little bit ago, July 7th, and then 2 days later, they killed that. Now, what that impact is on a Mexican farmer, on the Mexican farmers, is roughly $150 million of impact to their economy. So it's a big deal. Mexico wants to put those cows in. Once we start importing again, that's definitely going to have an effect on inventory and supply, and that will help cattle prices go down. And I'll show you a potential trade here in a second. When that reopening occurs, why cattle prices would potentially drop. So July 9th, it was halted again, and cattle were not allowed to be imported. Remember, we import 400 or 500 million pounds of beef from cattle, so this is a big deal. This is a very big deal. Governor Abbott in Texas has said that Texas is going to help. They were a big part of this in the 1960s. We're investing so far $8.5 million in a dispersal site in Moore Air Base. Moore Air Base is located in South Texas, about 14 miles north of the border, in a place called Mission, Texas, in deep South Texas. Think of Brownsville area. And they're spending $8.5 million at a site there, and they're going to go ahead and start creating those sterile male flies again, along in partnership with a facility in Mexico. They're going to spend $20 million in Mexico and produce these sterile flies. Then what they're going to do is the U.S. is going to take them over Mexico and start dropping these male flies by plane over Mexico to mate with the female flies and hopefully eradicate it from Mexico. This may take a little bit of time. Don't know, but that's the plan at this point. That was just a quick overview of the current situation that is happening with the screwworm, as well as what's going on with tariffs, and that's why cattle prices have been jumping up. So let's take a look at, I'm going to dive in now to the trade. But first, let's just take a look at the history of the last few months. So there you are. We're looking at this is cattle commodity, and this is the hog commodity. This is live cattle futures. This is the hog individually, and this is the spread in between the two. And this is the trade. You're buying one and hedging it with the other, or selling one and hedging it with the other. There's your hog prices. You're roughly around 75 to 80 cents a pound. Went as high as, it looks like, 86 cents a pound. And then cattle over here over the last several months, since July of last year, the cattle futures for December was running around $1.89 a pound up to $2.21 to $2.25 a pound. So you're talking about a 50-cent move in cattle prices with a steady climb. So the way this trade works is you're trading the differential. You don't care necessarily which way prices go up in terms of both hogs and cattle going up. It's a pairs trade. What you care about is the differential between the two prices converging. So here you're $1.40 apart, $1.41 apart between cattle prices and hog prices. That is an all-time high. A lot of that is driven because cattle prices are also at an all-time high. But what happens is if cattle prices increase, you're going to expect to see hog prices increase because of demand, supply and demand. Cattle prices get too expensive, U.S. consumers will pull back from beef and they'll substitute with pork. So think of that steak getting super expensive at this grocery store. You may instead decide on, hey, let's go with pork chops instead, or chicken or something else. And that'll cause pork prices to increase. So that's the construct with that. The average price between hogs and cattle over the last 10 to 15 years is roughly 80 cents. So think of between 60 and 80 cents. Well, if this trade in the next several months was to converge back to that, each spread that you enter is worth $400 per penny. If you're at $1.40, and let's just say we go back down to $1.20, let's not even go down to 80 cents. If we go from $1.40 down to $1.20, that's 20 cents times 400. You're looking at $8,000 per spread. Now, the inverse is true. If it continues to go up, let's say that screwworm migrates further north and causes a bigger problem in Mexico, you know then that the borders won't open and prices of cattle will increase even more, and beef prices at the grocery store will get more expensive. But you would think that pork prices would go up as well because it'll work as a substitute. So this is not financial advice. It is for education, but I wanted to show you this because you could make a potential trade if you believe that the U.S. and Mexico will work together to kill the screwworm, because once that happens, you will see cattle prices fall. The gates closed in May. Then they were talking about reopening. And then look at here on July 9th, when the USDA Secretary Brooke said that they're closing, there was a huge spike in price, which was driven by the cattle price, and at the same time, hog prices dropping. So it was a bad mix. So you've got the Brazilian tariffs, got this screwworm. So with that, let's go in and I'm going to show you the trade. All right, so let me show you LEZ 25. This is the futures contract for December. There's the current price. So it got as high as 222.47. My belief is when they open the border and allow the cattle to start flowing in, that will be a supply side enhancement, which will cause cattle prices to go down. That is my belief. So the way I'll trade this is, rather than just selling short and saying, hey, you know what, for every penny it drops, I'm going to sell this, but at the same time, I'm going to hedge it with hogs. So then I'm saying, I think cattle prices are going to come down, and I think hog prices are either going to stay or come up. If cattle prices continue to rise, you would expect to see hog prices to continue to rise, because there will be eventually a substitute for that. So that's how that trade works. So now I'm going to sell this one. I'm going to go and create an advanced order. I'm going to change this to first trigger sequence because I want to execute both of these at the same time. I'm selling cattle and I'm buying hogs. I'm going to go down here because it's still got cattle selected. So I'm going to click on more and switch that to hogs. And this one I'm going to buy, but I'm going to buy this one instead of the limit. I'm going to set this one to market. Go back to my group. So I've got sell one cattle contract and buy one hog contract. The spread differential is $400 per penny. Each contract represents 40,000 pounds of meat for hogs or cattle. So I'm going to review that, and you can see I've got this one. I'm going to limit order this so that I'm going to execute at a certain price and then instantly turn around and buy hogs at market. I don't want to enter it as two limit orders because then I could be stuck with the one executing and not the other. And if the other moves in price a lot, it could be very risky. So I want to enter them exactly at the same time. That's how I'll do it. And then I'll go execute this. So I am currently in this position. And again, this is not financial advice. This is just to show you how it's done. And go do your own research. Look up the screw worm, look at the tariffs, look at the impacts. Consider this trade if you like it, but it is up to you and it is on your own research. So I'm just showing you what I'm doing. It does require about $5,000 worth of margin for each side of the contract, a little bit less, but about $5,000, so about $10,000 to be able to do this trade. But you need to be prepared that if it goes against you, it's $400 per penny that the spread widens. So if this thing goes from $1.40 to $1.50 and that spread widens, you're out $4,000. You could lose 50% of your investment in that example. So just be prepared. That's it. Please hit the subscribe button. I like doing these videos and it lets me know that you like it as well. So thank you very much. Happy trading.